Welcome to Money Mode, the channel that makes money talk less confusing and way more useful. Let's get into it. NFTs once looked like magic, a digital picture of an ape selling for the price of a mansion, a market exploding from almost nothing to billions of dollars in months. Then the charts turned red and stayed there. So is the NFT market truly dead? Or is the real story more complicated? At its peak, NFT trading volume soared past $25 billion in a single year. Collectors lined up at midnight, newcomers rushed in with the fear of missing out. Prices for some collections doubled in a week. It felt less like investing and more like a lottery everyone wanted to win. Then reality arrived. Trading volume fell by more than 90% from its peak. Many collections that once sold for the price of a car became almost worthless. Investors who bought at the top were left holding digital assets nobody wanted to buy back. Why did this happen? Because most of the market was built on pure speculation, not real value. People were not buying utility or ownership rights. They were buying the belief that someone else would pay more tomorrow. When that belief broke, prices had nothing solid to stand on. This is where the Nordic approach to money offers a powerful lesson. In countries like Denmark, Norway, and Sweden, financial decisions are built on discipline and long-term thinking, not excitement. The core mindset is simple. Long-term stability matters more than short-term thrills, and true wealth comes from being able to rely on yourself. A Nordic-minded investor would have asked one question before buying any NFT. What is this asset actually worth without the hype? If the honest answer is nothing beyond a picture on a screen, discipline says step back, no matter how loud the crowd gets. Now compare that to how Singapore approaches wealth building. Singapore is known across Asia for a sharp, structured financial mindset focused on growing assets deliberately and planning retirement years in advance. A Singapore-style investor treats every purchase as a piece of a bigger plan. Before buying an NFT, they ask how it fits into a diversified portfolio, what percentage of total wealth it represents, and whether it supports long-term goals rather than short-term excitement. Then there is the American mindset, built around entrepreneurship and bold risk-taking. The idea of high risk, high return runs through American investing culture, along with the powerful dream of financial freedom, using capital today to build independence tomorrow. This mindset is not reckless by nature, it is calculated. Serious entrepreneurs accept risk only when they understand exactly what they are risking and why, treating losses as tuition rather than tragedy. So blend these three mindsets together, and a clearer picture of the NFT crash emerges. Most buyers had the American appetite for risk, without Nordic discipline to manage it, and without the Singapore-style structure to size the bet responsibly. That imbalance is what turned a promising new technology into a speculative bubble. The technology itself was never the real problem. The missing ingredient was mindset. So is the NFT market actually dead? The data says no. Trading volume has stabilized at a much smaller, more sustainable level compared to the frenzy of the peak years. What changed is the type of activity happening inside the market. Speculative collectors chasing quick profits have mostly moved on. What remains is being used for real purposes. Event organizers use NFTs as tamper-proof tickets. Game studios use them to represent in-game items players can genuinely own. Some companies experiment with them to track ownership of physical real estate and luxury goods. In other words, the pure hype layer collapsed, but a smaller, more useful layer survived underneath it. That is a very common pattern in the history of new financial technology. The hype dies first, then genuine utility slowly takes its place. For anyone still curious about this space, the lesson from all three mindsets combined is the same. Take the American willingness to explore something new, apply Nordic discipline to know exactly how much you can afford to lose, and use Singapore-style planning to make sure it fits inside a wider, diversified strategy. Never treat any single volatile asset, digital or otherwise, as your entire financial plan. The NFT crash did not destroy wealth on its own. It destroyed wealth for people who ignored risk management completely. This video is for educational purposes only and is not financial advice. Always research thoroughly and consider your own risk tolerance before making any investment decision. If you found this breakdown useful, follow along for more deep dives into how money really works around the world.